This is Chapter 6, Saving and Investing, discussion number 1, savings. So you've gotten a pile of money for working, and you bought your necessities. You should probably save some money. So how do we save money in the United States? Well, generally we put it in a bank so that it's less likely to be stolen. Savings, a very basic economic definition, is simply setting aside of money for a later time. Now, that means you could stuff it underneath the mattress, dig a hole in your backyard, or you can put it in a savings account. Now, savings accounts can provide interest. In other words, you'll have more money than what you started with because the bank is saying, thank you for putting your money in our bank. Now, that's not just an idea of pride to them. They use that money to lend to other people, and then they make money off the interest that people are paying for that. So that's why they like the money. But sometimes savings accounts can have strings attached. For example, there might be a required minimum balance. Some credit unions require a minimum of $5 so that you can claim membership in the credit union. Sometimes the minimum balance can be $1,000. It's whatever the bank wants to set, and then it's up to the customer to satisfy that minimum balance by making sure it's still in there. Sometimes savings accounts can require a waiting period before you get the money. For example, if you deposit a check and say, I want to put this in my savings account, and then you turn around and say, I'd like to withdraw money from my savings account, they're not going to give you the money you just turned in because they don't know if that check's good. And so there's going to be a waiting period to make sure that. A lot of times, though, if you're going to put your money anywhere, savings accounts are going to have a low interest rate because it's immediately accessible, so the bank can't guarantee that they can loan that money out and you're not going to come get it for a while. So the interest rates are going to be low on the savings accounts. But there's other ways that you can save money with a bank. For example, you could put your money in a money market deposit account, which does pay a higher amount of interest than the savings account normally. Now remember, we're talking a lot of generalities here, so don't say this is exactly what's got to be. There are other circumstances which might affect how the interest rates compare. But for the most part, money market deposit accounts do pay a higher interest. A lot of them do allow immediate access. You don't have to wait a standard amount of time. However, a lot of times money market deposit accounts limit the number of transactions. For example, one that my parents have allows them a total of 3 transactions a month, and that includes deposits and withdrawals. So if they have a plan that they're going to deposit money in the account twice a month, then they only have one opportunity to actually take money out in a month, and then they've got to wait for the next calendar month before they can withdraw money. Now, there is also the idea of time deposits. We also call these certificates of deposit. This is where you present a guarantee to the bank saying that I'm going to deposit this amount of money in the bank, and I promise that I will not take the money out until a much later time. So this promise is the bank gets the opportunity to say, we know the money's going to be here, we can loan it out without any fear that the person's going to take the money out. Generally, as you say that the money's going to stay in the bank for a longer period of time, is going to get you even higher interest rates. Now, when that amount of time is determined, that length of time is called the maturity, so that when the CD matures, it's now available for you to go get, and you've made your money plus interest. Now, a lot of times, I promise I won't get the money. Let's say you show up at the bank early and says, I'm having an emergency, I need that money now. The bank's going to say, well, you promised. And you're going to say, I know I promised, but I got to have the money. In that contract for that certificate of deposit, there's going to be an early withdrawal fee, which means it's going to cost you in order to get that money out early. So that's one thing you've got to be aware of when you do a certificate of deposit, that you're making that promise and it's going to cost if you turn out having to get the money early. So when you do savings accounts or money market deposit accounts, one of the things that makes these things such a valuable idea is the idea of deposit insurance. Especially after the bank failures of the early 1900s, the United States government decided it was necessary for financial security in the nation to make sure that when banks failed, all the money didn't disappear with it that belonged to the average depositor. And so they instituted the Federal Deposit Insurance Corporation, known as the FDIC. What this does is that banks are required to pay essentially an insurance fee to the FDIC for the money that it has in the bank. And so if any bank goes under, that the savings accounts, checking accounts, the money market deposit accounts, and the CDs up to $100,000 will be guaranteed for the depositors so that they don't lose their money. Now, in the last couple of years, with the severe amount of financial crisis, and there was worry that a lot of banks might go belly up, that number was upped to $250,000, but that was considered to be a temporary amount, and it's expected to go back down to $100,000 at least at the time that I heard. Now, all financial institutions are pretty much required to participate in the FDIC. However, the National Credit Union has established their own insurance setup, and they call it the NCUA, the National Credit Union Association. And so they have their own way of essentially insuring accounts. And to be honest with you, no bank wants to be without this because no intelligent person is going to walk into a financial institution, plop down their savings, knowing that there's a risk that they'll lose everything simply because the bank made a stupid screw up. And so they're going to so that's one of the ideas, that banks make sure that they're participating in these because it reassures their customers and that it allows them to get that money so that they can loan it out later. So it's a good business decision for them as well. This concludes discussion number 1, savings, as part of the discussion for Chapter 6, Saving and Investing.